Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, January 31st, 2022. All right, so we're heading into the last trading day of the month, first month of the year, and so I'm going to start the video out here on the monthly time frames because that's most important. It's how you close those candles on any particular time frame. In other words, a monthly chart, you got to wait for the end of the month to see how that candle is going to look because it's more than usual to see intra-month breaks of price support levels, trend lines, things like that, only to see whatever security you're tracking rally back up or drop back down and take out that level. I'm going to keep this video limited to the indexes only. I may touch on the FANG stocks because that's important, as well as the sectors within the index, depending on time here. But I want to just again, kind of stay up to date and do at least daily updates, if not more than one a day, on the indexes because volatility is still high. And again, I think there's there's already been a lot of profit in the markets, shorting on the way down. Biggest drop that we've had, biggest drop in the Nasdaq. They said, I think, since 2008, and that was the last bear market. So if that tells you something. All right, let's look at, and I'm sorry, the month of January, the monthly drop in the Nasdaq. All right, let's go and start out here on this monthly chart, SPY. Let me just tell you what I think are the most relevant things to look at right now. We have this is our monthly candle, and with about almost absolute certainty, we're going to have a bearish engulfing on the monthly. Remember, when we got the sell signals a few weeks back, I highlighted bearish engulfings on the daily and weekly on QQQ, SPY. This is now a monthly bearish engulfing. That's powerful. You don't get them often. We'll just look at those real quick. Just tell you what the definition is. The body of the candle on the current month must engulf the body, not the whole shadow, not the skinny part, but the fat part must engulf the body of the previous candle. In this case, we engulfed the last previous 2 months. There's December and November's candles completely engulfed now. Again, it would take a heck of a rally from here. We're already up today, and it's yeah, no, we got to rally another 4% to get back up there and not make this a bearish engulfing. The other component of them is that you want to see them. They come after a prolonged uptrend. They're reversal sticks, topping sticks. So you don't look for them right off a bottom. It doesn't mean much. That's not a reversal. Again, you want to see a prolonged uptrend, and that's really the first and only monthly bearish engulfing since the last. Again, you want to call it a correction. Bear market, it's semantics, 36% drop in the S&P 500. But let's just go over this real quick. Fat bearish engulfing right there. You can see it engulf 1, 2, 3, 4. The previous 4 months in one fell swoop. So that was the previous bearish engulfing candle. Back here, you had one right there, nice and fat, engulfed 1, 2. Maybe that third right there, and that was followed with a 20% drop. That's I'm measuring the drops are high to low. That was the fourth quarter 2018. Big correction, very profitable to trade. And then let's go back here. If you zoom in, I'll have to take it tight. I know you guys are in the video mode, especially if you're watching on your phones. Let's do this. All right, this was a 15% drop from high to low, high right here, and you can see there's your bearish right in the top. There was the market topped right here, and there was our peak, and that's where the 15% drop. Well, actually, yeah, oh no, I'm sorry, 15%. Let me make sure I measured that right. Let me turn off all these lines for you real quick and make sure I captured the high of that candle. And then before all said and done, this tells me it was a 9-month drop. Yeah, 15.29%. Most of it came early on, but then the market continued, never took out those highs, the previous highs, and again, a 9-month correction, if you want to call it. Well, that's what it was. Okay, so there is right here. This one's the bearish. There's your top. That's when the S&P 500, the market peaked. You had a bearish engulfing candle, never took it out. And again, you had a big drop that came quick, and then 9 months more before the low was finally put in. A total 9 months again from the peak there. Okay, we'll zoom back out. And then the other things, again, we don't have it yet. It's something to look for. The PPO is certainly rolled over, but it hasn't crossed over. And so that's not going to happen this month. At best, it'll happen next month. But remember, quite often, if you wait for that, by the time the crossover is official, a half or sometimes more or a quarter of the move has already happened. Again, it's just something that in some cases you have to anticipate or try to ascertain from the look of the charts. Is it likely we're going to have that crossover? And again, those crossovers have been associated with drops, as I've covered in the past, all measuring in double digits. Some, all the bear markets started with that. So that's where we're at. And then this is on the week, or I'm sorry, the monthly. This is the best trend line I can do here. You can't really come off the lows because it was such a quick down and then quick up. I have trend lines off the lows on the weekly and daily, but this is the monthly right there. And so looks like we're going to park a little bit below it or right on it. Again, depending on how the day closes. It's only 11 o'clock Eastern time right now, so 11:03. Plenty of time left in the day. All right, we'll stay on this long-term frame, and then I'll walk it down to the weekly and daily. All right, so let's look at the other big one I like to track, QQQ. And no matter what happens, we're going to have a solid crossover on the PPO this month. It happened earlier in the month. I was pointing it out when it's before and right after, and that's a solid red candle. And again, I'm sorry, no red bar on the histogram. I mean, the PPO crossed over. Last time we had it, 31% drop. Time before that, you had it before all said and done, a 24% drop, 26% drop. Again, those are all came after the bearish PPO crossovers there. The other things that we have, the other key features here, we have a fat bearish engulfing. It engulfed, just covered that previous doji right there, the body of that doji, that candle, that candle, that candle, that candle, that candle. My goodness, this is pretty powerful, and let's see what happens. And this is why and how technical analysis works. It tells you that everybody that was loading into tech stocks, Apple, Microsoft, Facebook, the likes, or even tech-heavy mutual funds and ETFs that such as QQQ, of course, but those that are pretty much growth funds. This is where growth has been as tech. Tells you that they've been wiped out 1, 2, 3, 4, 5, 6 months of gains, wiped out in one fell swoop in 1 month. That's how that works, and that's what makes a bearish engulfing candle, pretty powerful thing. So, anyways. And I said this when we got them on the daily a couple months ago, and then the weekly. You want to see follow-up, and most importantly, you just can't take out the top of the candle. Then it's all, it's no longer. It's just a random bearish engulfing that came in an uptrend, but it didn't signal a top. So as of now, that's it, and that's we have it. And again, I just showed you the statistics. Oh, and what I didn't show you, I showed you on S&P, the S&P 500, but. Let's see, we go back here, I'm looking. Okay, the previous bearish engulfing came over a year ago, about a year ago, I'm sorry, 2 years ago. That was back in 2020 when COVID first hit. Gosh, has it been that long? Yeah, it has. Solid bearish engulfing wiped out the previous at least 2 months there, and that was associated with a 31% drop in QQQ. Before that, we had a bearish right here, engulfed these three, at least those 3 or 4 previous candles, associated with a 24% drop. And again, months. Each one is 1 month, so that was a time that even if you were a diehard bull, you would have been very happy if you got out of the market, or you would have been very upset and seen a lot of give back. You probably would have been stopped out somewhere along the way there. Should have been. And then right here, bearish engulfing. You see that big one? We had a little mini crash there back in 2015, but completely engulfed the previous candle, and that was associated with a 26% drop. Okay, so enough on that. Those are the things I'm looking at. There's a trend line. We're going to close below that. So what I'm doing is reiterating the case that I am longer term bearish, despite what happened on Friday. This is when, and today, market being up, that's nothing. Volatility has expanded. That is the nature of a correction or a bear market. Volatility goes up significantly. The daily swings, it's normal to see up and down 3% plus in a day. Even we saw swings recently of a 5, I think even 6% daily swing in the NASDAQ 100. So you've got to just accept that and not try to chalk any one or 2 or 3 day move up to bullish or bearish unless it does something technically significant. What I mean by that, so I've given you levels where if we rally beyond those levels, yeah, I'm going to start second guessing my longer term bearish outlook. I'm going to start, be more concerned with where I'm going to stop out, cover short positions, maybe take longs versus adding to short exposure, adding shorts. So we're not there yet. That's the takeaway, guys. I just spent quite a bit of time here on the monthlies. Oh, and then we'll just, for kicks and giggles, look at the small caps. IWM, actually, IWM peaked before. We had a bearish engulfing here on the monthly right there, and never closed below it, above it. I'm sorry. And so far, we went sideways for a while, and then boom, down, and we're heading down. Solid bearish PPO crossover this month. There's no way that's getting undone. Will it prove to be just a little aberration, a blip, and will this prove to be the one of, if not the smallest drops, and I'm talking all of them, QQQ as well, and IWM, will it prove to be one of the smallest drops associated with a bearish PPO crossover? Possible. We'll see. Time will tell. Let's look at some other levels, and let's walk it down to the weekly. I don't want to beat a dead horse, but again, we got to look at these levels now. This gets more of, okay, tactically, that's more strategic when you're looking at a long-term charts. What am I doing with long-term funds? Where do I want to be? Where do I want my bias with swing trading? In other words, what I mean by that, well, you got to have a bias. Can't stand when people just replay the charts, don't have any bias. No, you need to know as a trader, as you guys know, all I do is talk all day about support and resistance levels, trend lines, rip levels. As a trader, I need to know which support levels I want to go long on when we pull back to, and which support levels I want to wait because I expect a breakdown and wait to short. Likewise, when we're going up, what resistance levels do I want to short into and put stops above versus which ones do I want to wait for a breakout? That is what I mean by that. So if I am bullish on a security, I'm going to look to go long on a breakout above resistance or pull back to support. However, when the charts tell me that the charts are bearish on that security and indicate whether it's in a bull trend or not, that doesn't matter to me. I will short bullish stocks in a solid bull trend. I mean, we shorted the highs in the strongest bull market in decades, and because the charts were indicating, although the trend was bullish, the charts were bearish. Hope that makes sense to you, at least my interpretation of the charts. I'm not, concerned of what happened yesterday. That's, to me, left side of the chart. This is where, that's why I call the site right side of the chart. This is where I'm, looking and predicting where things are going to go. Everything to the right of the current prices. All right, so that's that. And as of now, long term, nothing at all has changed. In fact, all we did is we hit those first targets on the SPY, QQQ. We hit this level I added here, and this is nothing more at this point in time. Again, it can change, that can morph into something else. Nothing more than just a reaction off support, and now we're on a weekly time frame. We're still, the flags on the dailies are hanging in there. They're more clear on the weekly. You can see, impulsive move down, i.e. flagpole, and a little flagging action there, possibly in IWM, small cap ETF. And there's, of course, still my target. So nothing's changed. And when does it change? When will I start? Well, we'll have to, maybe I'm wrong. Maybe there's more bounce. Need to take out at the very least, take out with conviction the bottom of that range there. There's the 40-week moving average right above it. So that's IWM. Let's look at the Qs. QQQ, again, said it 100 times in the last week or so. We hit my first target. I list multiple targets because each and every level is where I think a reaction is likely. It's not guaranteed, but 90+% of the time, I would say, on the price targets I lay out, you have a reaction, and I define that as a bounce and or consolidation. So when you look at it here on the weekly chart, and we turn off all the lines for a second, you're still seeing what looks to be flagging action. You have an impulsive leg down, right? And a little kickback. There's that key 40-week exponential moving average, and the 200-day or 40-week simple is right there as well. I turn that up. That's in blue. And again, that's when you cross down below them, you're usually now in bear market territory, at least correction mode, and they act as resistance when back tested from above. Once you regain them, that's bullish, and then they act as support, the 200 days. Bearish when below, and you can go back as long as you want. You can go back 30, 40 years. You'll see they do a great job. The only time that they really you'll get some whipsaws is when the market's in a kind of choppy consolidating area. That was what we had. I call it a deer market. A deer market is a term. It's neither bull nor bear. It's in between the two. And we had 2 years almost of sideways action, but plenty of corrections in there. And that's where moving averages and trend indicators tend to get more whipsaw signals. But otherwise, when the market's trending, they do a great job. So that's that. Let's look at SPY now. Let's look at SPY on the weekly. We're just walking down the time frames. There it is, still back testing. There's the 40-week is in blue. A simple moving average. That's the same as the 200-day moving average. We're back testing it just as we were last week. Remember last week I told you we had multiple chances to add objectively short there, and we're right there right now as I do the video. The top, that box, the top of the body of the candle is right on the 200. Be close enough when we go to the daily. And that's it. But that's not the big level. Well, that is one level. Like I said, I can't, all I can tell you is what are the resistance levels that are likely to come into play, especially if I'm correct and we're going to go down lower. That's where I can tell you right here, what I said last week, all the way up to, but really not much above. I'm going to round that up now. It keeps bothering me every time you get within a few pennies. I had it at 450.97. So I made it 451. Again, that is a big level there, and that's what put us on, or gave us additional check marks. We had sell signals early on back here. So again, it was the breakout of the high right there. It was back tested several weeks, and then the back test finally failed with a big impulsive candle, and that was a powerful sell signal. Then the 200s were taken out. Now they're being back tested. So it's pretty much the same analysis as last week, guys. I just kind of wanted to address the strength over the last two sessions, mostly attributed to Apple. Apple's an earnings juggernaut, and it looks still technically the best of the bunch. But if I get a chance here, I'll cover that real quick. But there's SPY. We're still kind of pushing the limits. If you can either use that as the top of the flagpole or that one. This one looks a little better, and there's our little flagging action. We're again right at the 200 or hair above it on the daily chart. Here we're on a daily time frame. We'll see where we close. Remember, it's the last day of the month, so for that alone, you might want to expect some volatility. And we've crossed down below here. PPO is down below that negative 0.64 level. That does a good job of defining trends. In other words, when the white line, the PPO line, crosses above, the trend's bullish. And it has remained without zero exceptions until here. We've stayed, again, it's the white line. That's the last of the two to cross, and that's signaled. So there's, check mark, if you will, for the bearish case. And, this is it. So maybe the flags don't play out. But if they don't and there's some more upside, we've got some big resistance coming up ahead. And that's where, again, you can short up to, but I really would hold off. You can have wider stops if you want. But if we happen to pop above the top of this range here, 450, 453 in that area, the only time I would want to add any more shorts if I'm going to hold on, and if it proves to be a whipsaw, is on a failure. So you pop it, it'll be a big stop, clear, and run. Then you'd want to wait to see a failure back below that level. But as of now, like I said, things are pretty much where we left off last week. That's SPY on the daily, QQQ on the daily. QQQ, and remember we had some trend lines here, downtrend lines on the indexes that were taken out. QQQ popped that. It kind of foiled the bearish pennant, so I'm going to have to remove that now, no longer a pennant. Again, if we look at it, as I just showed you a minute ago, on a weekly, we do have the flag shape there. In the daily, before I had a bearish pennant, now it's more of a flag, if you will. It's getting a little big, symmetry-wise compared to the flagpole, but it's not completely gone here. Let me draw it out here. Daily chart, down move, flagging action, and we'll need to see reversal. So end of the day, let's see what happens. Window dressing is a term used when mutual funds will, a lot of them will report their holdings. They report them either on a quarterly basis. Some might report on a monthly basis. And we know we're heading into a rising rate environment. That's not going to be good for stocks. And this is, I already hear the media coming out, the cheerleaders after just 2 days of rallying, they're parading the cheerleaders out on, bubble TV and saying, well, it's just an adjustment, perfectly normal adjustment. The growth cycle is still intact and blah, 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 blah. Well, for now it is. But look, I'm going off the technicals, and as of now, the technicals say those sell signals that we had recently, there's some pretty powerful ones, are still intact. And that yellow line, remember, that was a big level for me back there when QQQ broke it. And so QQQ could certainly rally quite a bit more just to get to the bottom of that topping pattern right there. Remember, we had that topping pattern there, and it was a back test of the high. So there's plenty of upside if QQQ wants to rally before it starts to give me X's, check marks for the bearish case, or what I see, bearish developments. We'll call them X's would be, or minus signs, or whatever you want to take away those. And so there's still plenty of upside there. All right, let's look at IWM, and then I'll drop down to the 60-minute charts. And this is IWM is probably one of the more bullish ones. You got on the daily, you had a very clean uptrend line, pretty clean. We popped it. But and we do have RSI divergence. That's the other thing. When we get down to the 60-minute charts, I didn't have the divergence I usually see during when we're in a powerful correction or bear market. It's those 60-minute divergences. I like to see them on the futures and or ETFs, particularly SPY and QQQ. One or the other, better if I get them on both. Didn't have that this time around. So to me, I'm still viewing as any strength in the market as a objective shorting up. IWM, it's got a long way to do it. I don't think it'll back test it because we're so far away, but that's a major resistance, about 208.50. This was such a powerful sell signal to me when we broke down below there, because that was, look at that, over a year of tight consolidation in a well-defined sideways trading range and a breakdown. So that looks like the initial leg down of a move with more to come, in my opinion. So you guys do what you want, but again, I'm using any short bounce backs into resistance, things like that, to add into shorts and still maintain my first and initial target of 170 in IWM. All right. 60 minutes, we'll just walk it backwards. I'm on IWM now, so we'll go there. Bullish falling wedge, got to recognize that. Remember I told you on the 60-minute chart I like to see that, so it is there on the small caps. There's a wedge, may or may not play out. One little caveat, if you will, I always mention this, in a bull trend, bearish chart patterns have a much higher rate of failing. So they'll either not play out at all, meaning not trigger or break out, or they break out, and just as things look like they're going to drop, the buyers step in and they kind of foil it, and the patterns fall, the move out of the patterns fall well below their measured targets. And when you flip it around, when you're in a bear trend, same thing. This was talked about at the time, beautiful bullish falling wedge, right? And the wedge, the widest part of the wedge is your measured target. So that wedge should have took us at least here. And more importantly, the MO, the modus operandi of this market for over last couple of years has been these 60-minute divergent lows, and I'm pointing them, just about all of them out, have been the catalyst to the move to the new highs and beyond. Every time we had that after a little correction, buyers came in, and so this is a change of character. We fell well shy of the measured target, and we certainly never saw new highs, and so that's just something, again, I wanted to throw out. I'd be remiss not to point this out. My job is to provide analysis. Your job is to decide what to trade and how to take that analysis, whether it complements your own, refutes it, do what you want with it. But if you're bullish, then trade the wedge. Just trade it mechanically. If it breaks out, take the long, with stops somewhat below. If it fails, maybe allowing for a back test, and you can see, well, I'm not laying out targets. That wasn't the point of this video, but did want to point out the wedge. And so whether it pops now or comes back down, it could continue to form, and as long as we have those divergences, we could see a nice counter trend rally in the small caps. So food for thought, especially if you're an active trader, a flexible trader like me. I don't mind going long or short during corrections or rallies, looking at the intraday charts all the way down to the 5-minute charts. QQQ. Okay, this chart's getting a little busy because I have a lot of lines there. We've had a lot of analysis on QQQ, all our sell signals up here. Shorting ops there, T1 hit, T2 hit, T3, T4, and then T5, and we were on the way down. That's when I started to turn my focus towards the additional targets on the daily and weekly charts. But what's happened on the 60-minute time frame is you had a nice little clean downtrend line right there on the Qs. No divergence. You would have had if we made a new low right there or an equal low, but you didn't. Either way, but you had a trend line, well-watched trend line, this little area of consolidation there, maybe a W bottom. So, bulls are foaming at the mouth right now because of the big rally, thanks to Apple on Friday. 6.3% pop since that low the other day. And I added a couple lines here in purple that are potential resistance levels. They're minor resistance, 357 and about 361.15. But again, the big level here, just to turn everything off, all the lines, bigger picture. It's hard to call all the little micro squiggles, but this is really where QQQ had those that trading range there, and then boom, fell down. So could be more upside, but if we're going where I think we are, especially if those flags break down, we get some funds dumping positions at the end of the month here because they don't want to show that they're chalk heavy and all these tech stocks that are getting hammered. You could see a big reversal today, and if you do, then we still need to take out the recent lows, of course, really open the door, but or break out below those flags. Anywho, there's a 60-minute chart. I'm going to just show you real quick. I have right here. Yeah, I have fibs. Fibonacci retracement levels. I used the high in QQQ, which was back in November. Then we had a subsequent high. We did some consolidating there, sideways, and then another big drop. So I put them both up, and these are called, traders will use these as what we call Fibonacci clusters. And so I'll use that. Both of those are significant highs, and they're coming together. This is the 38.2, which is usually the minimum fib in a counter trend rally. And so if that's all this is, if this is just a counter trend bounce over the last few days, last week or so, in a correction or a bear market with more downside to come, then one would expect it'll probably terminate anywhere from about here, the 38.2, up to about here's the 61.8. Again, yellow just comes off that high, blue comes off that high. So there's my bounce target range. And look, never fails to amaze me how well they line up with my price resistance levels. I just put these up today, and you guys know I have, been talking about that bottom range there, about 380 roughly on QQQ is the bottom of that recent trading range, and so that's your bounce target zone. Now, the thing about it, the charts to me pretty bearish. You can wait for that if you let's say you're longer term bearish, but if you wait for that, it would be a great shorting op if we get there. But the thing is, I think there's still a lot of trap longs in the market, a lot of people that want to be short, and so I would just scale in. I definitely have some shorts here. Took some home in the swing account over the weekend, and I'll continue to build up to, but not above that position. I will not keep shorting there. Unless there's something in the charts that really stand out, something I missed. So we'll see. All right, so that's the fibs on QQQ, SPY, the S&P 500. It's more of a distinct single high right here, the all-time high right there. Initial move down. There's a 31.82 fib right here, this line, which we're a hair above right now. And that's also a breakout above this recent consolidation range. So if this breakout should hold. If the correction's over, that should hold. Doesn't have to, but it should. Bulls should step in and buy there. A failure will mean a false breakout there, and then that probably send us back down. But you can see there's plenty of room. Here's the 61.8 fib all the way up there, but you also have the bottom of the trading range there, right on the 50. This is the 50% fib. 50% retracement. That means half of the losses there would have been regained, and that level is right at price resistance, about 450 on SPY. So that's how it looks there. Remember key support. I had that yellow line there, and when we broke it, that's where the waterfall selling started. And so it's an obvious area to short. The problem, I think, is so many eyes see it. It's you're usually not going to get there. So. Maybe not. And again, if we pop it, each and every click or tick, I should say, above that level is nothing but bullish. There's still a mountain of resistance overhead to contend with, but maybe this proves to be the best buying op of the last couple years. Okay, let's run through the at least the top sectors, the ones that move the needle in the S&P 500. That'll make them so the video doesn't go so long. Basic materials, REITs. Hey, they're great trading vehicles. There's no reason not to trade them long or short, but they're not going to move the needle much on the S&P 500 because they have around a 3% weighting, where XLK Tech is over a 25% or quarter weighting. Trendline in the big yellow colored yellow, about 160 right there. That's about where we are. I have the line at 159.91. We're 159.77, and hence this makes this an objective level. Remember, there's also the bottom of that the pattern. I should put a level here on the weekly. Let me do that right there. We could head up there, but that was that previous all-time high, which we failed and broke out. And again, you have the trend line just above. So this is it on XLK. Trend line, major uptrend line, price resistance, more of a resistance zone where, again, that will likely cap this kickback rally, and anything much above that, and again, it's incremental. It's not all or none, meaning if you pop above 164, doesn't mean we're guaranteed to go to new highs. It doesn't put the odds at 100% that we're going to continue higher. Again, it's incremental. If you pop it, if and as you get away from there, the odds go down proportionally. Let's just say that. All right, XLK, that's tech. That's on the daily chart. This is XLV, healthcare. Same thing. So many of these sectors, they've broken down. They put in divergent highs. We had a little flagging action there. That flag played out. Looks to be flagging again. But most importantly, we're right at the 200-day moving averages and below the trend line. XLV is healthcare, and that's the second largest sector in the S&P 500. XLF, financials, nothing much has changed. Divergent high there. We have some resistance here that we're struggling with right now, about 38.90. That's where it's at. Big levels, I'm going to color it up here because this one would be pretty big. If the financials take this out, about $37, let's make that a round number. That would be pretty bearish. You can see it was nice. It was resistance here. We broke above it, back tested, just 2 days of whipsaw through there, but then got above it, back tested it again, back tested it again. Look at that. So you want to set a price alert to know when to short or add to. I already put a short out on the financials, and this was a breakdown here, a back test of a longer term trend line. And to me, this is just flagging action. Boom. So, and again, when will we know for certain it was a flag? Well, for certain if the whole thing plays out, but at least we need to break down below there. And again, I think the recent lows will do the trick. XLC, communications, same thing. I mean, this is, just recognize for what it is. We're in a downtrend, a near term. We're in a long-term uptrend, bullish. Near term to intermediate term, depending on how you want to define that, is downtrend just about every sector right now. XLY fell, hit a nice support level last week, several opportunities, and it's bouncing. Nothing goes down forever. Flagging type action as well. XLI industrials, big level. I'm going to change the color here to yellow so we know that's very significant. And that's it, 97.80. I'll stop at industrials, but big level. You can see the trading range here. This is, remember IWM I showed you trading sideways for a year? This is exactly like IWM. Same kind of pattern. You even had, just like IWM, let me go back to that and just compare the two. You even had a false breakout to the upside of the range that incurred with negative divergence, and then it never looked back. Finally, but the final nail in the coffin was a breakdown above 208.40, and we had a very strong and impulsive drop. Shows this was an important range, well defined, and then you go to the industrials. This just looks like IWM did before it broke down. You had a pop there, 2 failed attempts to break above the top of the range right there. Each one, you extended this divergence. You had negative divergence, particularly at that most recent high, and now you're sitting there. So I guess I can wrap it up here because I was gonna go over each of the fangs as well, but the story is the same. We fell to and hit key support levels on not just the major stock indexes, but many sectors, such as this one. And we're still precariously close to those levels. At this point in time, this seems to me, based on the posture on the weekly charts, moving averages, everything else, seems to be just consolidation around support. And it's simple. If you are bullish, you can buy. You can bought the market last week. I mentioned it there. You could have bought, T1 on QQQ and SPY with stops somewhat below the recent lows. If you think that there's a lot more upside left in this bull. If you're not, and if you're bearish, I give you levels to short into on kickbacks to resistance, or I like to say, because you can do both, short those breaks, rallies back into resistance, or wait for support. If you go through your charts, and I covered just a handful of charts, securities. There were different time frames I covered. Just set alerts. That's what I like to do. So, for example, 97.80 is a big level to me. I set an alert. And then, because if I take my eyes off XLI over the next week or two, if I get a price alert there, I know another sector is broken down. Until then, we're still within a trading range. And the thing about this, these trading ranges can go for a long time. This one's getting long in the tooth. And again, maybe we hold support. But if we break it, and I have price alerts set, let's say on most of these sectors, the key levels I showed you, key market leading stocks, and all those alerts start going off at once, that tells you, hey, get in quick, because support's breaking on not just one sector, but multiple sectors and multiple key stocks, and that's usually when you get that very sharp drop. A lot of sell orders take place, stops are hit, and look, if you don't, maybe you if you're not in front of the computer, all you can do, you can get these alerts sent to your phone or email as well, and then try to react. Or you can, if you can't get to a computer, you can have sell stop orders. That is, let's say you want to short XLI, for example. It's kind of like a stop loss, but it's called a sell stop, where you say sell XLI, X number of shares. If it crosses below, maybe you want to give it under the recent lows right there, about roughly 96.65. Good to cancel. And then some brokers have those. Not all brokers have those orders. And it'll automatically sell you, get you short if it triggers that break there. Alright, I'm going to wrap the video up here, and I'll do updates on commodities, treasury bonds, crypto, everything else later. I want to say that wheat and corn have broken down. Sugar, which I put a short trade on recently, continues to move lower, but probably get close to covering that one. I'll go over that in the next update. This has been Randy Finney with Right Side of the Chart. Have a great day.